Hi, welcome to the webinar today, everyone. Thank you so much for joining us. We are glad to have you for this topic today with one of our new speakers, Austin here. Hi, Austin. Thank you for joining us.
Good morning. Thank you.
So before we hand it off to Austin, I wanted to start first just by letting you all know that we are recording this full webinar and we'll be sending it to you all tomorrow in an email with the slides and Austin's information as well for further questions. We're going to be here for about an hour, give or take, depending on how many questions you all have. And speaking of questions, if you do have questions, can you please put them in the Q&A box, preferably not the chat box. The Q&A box is a great place to put your questions because it helps us to sort through them a little easier. So if you do that, we'll address the Q&A questions first, and then I might go back if we have time and check the chat. So as y'all are coming in, if you could please put in where you're coming in from, that would be great. We'd love to know. Say a hello in the chat box if you would like. I have a couple of resources that I'll be sharing in the chat box later on, so keep an eye out there for that in the chat. And also, I wanted to give you a brief introduction about our speaker today. So Austin Bowlin is a CPA. We love CPAs, right? Always getting our tax information from CPAs. He serves as the Chief Exchange Strategist and Partner at Real Estate Transition Solutions. He has a background in public accounting and real estate investment planning, which is great for all of us on the call. He leads a team focused on helping clients defer capital gains taxes through 1031 exchanges, and he works closely with property owners to design custom transition strategies, including Delaware Statutory Trust for passive income and estate planning. And he's a frequent speaker on tax advantage real estate strategies. We're going to be talking about 3 of them today, which is great. And he's known for making complex topics approachable and actionable for investors of all experience levels. So that's good news. I'm sure we have a lot of diversity here, some investors that have been doing this forever and others that are a little new to the concepts that we're going to be covering today. But I think you'll all learn something a little new. So Austin, with that said, we'd love it for you to share your screen and get the presentation started on these really smart exit strategies.
Excellent. Well, Alexandra, I appreciate the introduction there. Today, we're going to be discussing exit strategies for investment property owners. So a fair amount of content. We'll be moving quickly through it, but we'll make sure to save time for questions at the end and throughout the course of the presentation. I appreciate you all carving time out of your day to learn more about these exit strategies. One of the 1031 exchange replacement property options that we'll be discussing is what's referred to as a Delaware Statutory Trust, or DST as it's more commonly known. We'll share more about this on coming slides, but it's important to note that Delaware Statutory Trusts are unique in that they are both eligible for 1031 exchange purposes as what's referred to as like-kind property, but also treated as securities per the SEC. Specifically what's referred to as a Regulation D security. That does require any individuals exchanging into DSTs to be what is called an accredited investor. Now, typically an investor is accredited by virtue of having a net worth in excess of $1 million, not including the value of your primary residence, or alternatively, you can be accredited by virtue of having annual income in excess of $200,000 if you're a single filer, or $300,000 if married filing jointly. But do know that that is a requirement in order to exchange into DST replacement property. What you see here is an overview of what we'll be discussing today. I'll give a little bit of background on our firm, Real Estate Transition Solutions, or RETS as we're commonly known, in terms of the work that we do with investment property owners. And then we'll pivot into an overview of just all of the options available upon the sale of investment property. Then we'll unpack the 1031 exchange in more detail and lay some of that foundational understanding for the primary tax deferral strategy, and then unpack the Delaware Statutory Trust, given that it is often the least known replacement property option, albeit a very popular replacement property, especially over the last 5 to 7 years or so. As I noted, we'll share some educational resources and then also make sure to save time at the end for any questions we are not able to get to throughout the course of the presentation. Our firm, Real Estate Transition Solutions, is a real estate advisory firm that focuses on serving property owners that are navigating the transitions between the third and the fourth quarter of property ownership. And really, the premise behind our firm's work is recognition of the fact that investment real estate ownership is dynamic. The physical properties that you own today change over time, whether it's deferred maintenance or capital improvements that are necessary. The tenant profile changes within those properties, market conditions around the properties change, the interest rate environment, inflationary environment, valuations, and then, as all of us are very well aware, the regulatory environment changes around the properties, often far faster than any of us would like. On top of all of that, inevitably, owners' objectives change as they go through the chapters and decades of life. And what can commonly occur is an individual acquires real estate, adds some value to it, figures out their strategy, really working toward what is viewed as kind of this promised land of owning and operating, managing quote unquote stabilized properties. But as they go through these years and decades of ownership, their objectives themselves change. And in turn, there can be a gap between how the properties perform, the nature of the properties, the characteristics, and the property owner's objectives, whether today or the coming objectives over the next few years or decades. The work that we do centers around working with an investment property owner to analyze their investment real estate, to discuss and determine the owner's objectives. And if that gap is present, then to design and develop and ultimately execute a cohesive and intentional transition strategy. Because we are talking about investment real estate, what you have available to you is the ability to defer your tax and rebalance your portfolio, if you will, so it does reflect your objectives for the years and decades to come. One of the beautiful things associated with real estate, on top of the ability to exchange and defer your tax, is the fact that if you continue to defer that tax until ultimately you or your spouse, if applicable, pass away, then that tax liability is eliminated by way of a step up in basis for a surviving spouse. And again, eliminated for beneficiaries that will ultimately inherit the assets. So commonly the question is, what's the best form of ownership, best property types, best markets to be invested in to get me from where I am today until that point of the eventual step up in basis? All of that is to say, we perform a significant volume of 1031 exchanges with our clients. These statistics that you see here are as of Q3, so they're quite fresh, just a week and a half old or so at this point. We've completed nearly 1,000 1031 exchanges with investment property owners. We really specialize in what's referred to as fractional ownership of large institutional property, and that's primarily utilizing the Delaware Statutory Trust and the tenant in common replacement property ownership structures. In aggregate, we have just over $1.5 billion of DST real estate under advisement with our clients. Comprised of just shy of 2,000 individual investments among just north of 300 individual DSTs themselves. What you see here is a quick snapshot of some of the key individuals in our firm. We're actually headquartered all the way up in the Northwest in Seattle, Washington, with offices down the West Coast in Portland, Oregon, San Francisco, and Orange County. But we work with investment property owners all over the United States. Why work with a 1031 exchange advisor? Well, first and foremost, the approach that we take with property owners really starts with education. It's making sure that investment property owners, whether we work with them on a long-term basis or just having a one-off conversation, understand the options that they have available to them, understand the implications of a 1031 exchange. Does a 1031 exchange make sense for your specific situation? Which, to be clear, is not for every property owner. There are certain objective sets or considerations around the sale of a property where an exchange would be best not to be performed. Then it is making sure that there's an intentional strategy so that there are no surprises down the road. One of the considerations around 1031 exchanges that always has to be taken into account is the fact that there's a rigid and fairly short timeline associated with the transaction. So it's critical to go into the exchange knowing what is not allowable so that there are no surprises that could ultimately lead to perhaps having to recognize your tax liability, or sometimes even worse, acquiring a property that is not truly reflective of your objectives. And then it's that long-term support and servicing the client. Our firm is very intentional about making sure we are not transactional in nature. It's a long-standing relationship, integrating in a client's other advisors, be that their financial advisor, tax preparer, estate planning attorneys, et cetera, to make sure that the transaction and the strategy that's being executed upon is looked at holistically and everyone's informed of what occurred. Due diligence is a major differentiator of our firm relative to others who operate within this space, and something that we've invested extensively in over the past 10 years. Here's a quick snapshot at a very high level of a two-layered due diligence approach that we take when looking specifically at DSTs. But the same approach could be implemented if you were to acquire your own fee simple property that you own and manage yourself, or if you're utilizing third-party property management. We work through about a 6-month sponsor level due diligence process. These are the operators, the managers of the institutional properties that we provide to our clients. And then should a institutional real estate firm, a sponsor, successfully make it through that process, then we will underwrite each and every property that they put forward as a candidate for replacement property for individuals performing exchanges. So with that, let's dive into exit options available to investment property owners. One of the ways in which you can broadly categorize investment property owners is those who are still very much active in acquiring and growing their investment real estate portfolio, and common theme being really rolling up their sleeves and typically adding value to properties, whether that's physical improvements, whether that's changes to the tenant profile associated with the property, the lease structure, whether it's assembling properties together, so there's development potential. But there's a category of individuals who fall in this active investor realm. Those people do not perform 1031 exchanges at the same rate in which we see this other category, those who are looking to transition into more passive ownership, that are wanting to perhaps diversify their asset base, that have owned investment real estate for likely decades and have thus accumulated a significant tax liability if that property were to be sold. Those that find themselves in more traditional retirement years with 10, 20, 30 years of ownership, it's often a necessity to perform an exchange because the tax consequences are so significant were they to just outright sell a property. And additionally, going back to what I mentioned on an earlier slide, given the fact that if one continues to defer their tax liability until ultimately a step up in basis is realized by virtue of someone passing away, the gap to close until that date is shorter the older you get, inevitably. So often these individuals will utilize 1031 exchanges to keep those dollars working for them. The question then becomes, what replacement property ownership structures and property types are going to be the best fit for them? What you see here is a snapshot of the available exit options upon the sale of a property. And we'll walk through each of these in a little bit more detail. First and foremost, whenever you are selling investment property, you could always choose to recognize the tax due upon the sale. However, typically, especially if you own property in a state that has a state income tax, those tax consequences can be significant. What you see here listed on this bullet point is the highest applicable tax rate for an individual who either resides in or owns investment real estate in California. The tax consequences can be as high as 42.1% upon the sale of that property. What's included within that 42.1% is going to be federal capital gain tax, 20%, or federal depreciation recapture tax at 25%. And when I say or, it's not a matter of it's either going to be this tax rate or that tax rate. Different components of the sales proceeds will be taxed at different rates. Both of those categories, the appreciation that the property realized and the sum of all of the annual depreciation that was taken over the period of ownership, will be subject to one of those two taxes, 20% or 25%, plus 3.8% net investment income tax, plus state income tax. And in California, that can be as high as 13.3%. We've talked to many property owners who have assumptions as to how that tax liability is calculated. It's a critical input to know when determining what should be the best next step. So if you have a question as to what your estimated tax liability might be, I would encourage you to reach out to us or utilize our exchange calculator available on our website. You can find that at re-transition.com/AAOA, which is our AAOA hub page. And that calculator will allow you to type in the specific inputs for your individual property, how long you've owned it, what you paid for it, capitalized improvements, accumulated depreciation, the sales price, estimated closing costs, and then see what an estimated tax liability would be. The next option puts us into the realm where tax deferral is achieved, and that's by way of the 1031 exchange. You can exchange into a fee simple property, a property that you own yourself, or multiple properties you own yourself. You could choose to manage those yourself. You could choose to utilize third-party property management. You could exchange into a property that eventually is going to be repurposed to become personal use. So maybe you have 2 years of rental income and then you move into the property, or you use it as a vacation home, a second home, whatever it might be. This is arguably the widest tent in terms of strategies and different properties available within it. The third exchange category would be exchanging into fractional ownership of large institutional properties, typically done by way of the Delaware Statutory Trust or the tenant in common. Here, you can have full tax deferral. You can invest in higher quality property that's going to be passive from an investor standpoint, typically generating monthly income for you. And then with the traditional structure, that property would be owned and managed on your behalf for a period of time, often 5 to 7 years, then sold, at which time all the sales proceeds are distributed back to you, such that then you get to determine what you want to do next with those funds. And then lastly, an option that wasn't all that prevalent up until interest rates started to increase in 2022 and at a rapid rate, and that's the installment sale or seller financing. Here we've seen deals that need to use this structure in order to get to a certain target pricing that a seller has. But effectively, what's happening is the seller of the property is turning into the lender for the buyer of that property. A very common strategy here, or common structure for seller financing rather, is where a buyer will offer 20 or 25% down for the property, so a down payment on it, and then carry a note, say a 5-year interest-only note at 5 or 5.5% interest rate, that then is paid off in a balloon payment 5 years post-close of the sale itself. The tax implications for that structure, I think many people assume, oh, this provides tax deferral, and it does. However, it is temporary tax deferral. And there's a couple components that need to be understood for anyone who's being approached by a prospective buyer or a broker that's introducing an offer using the seller financing arrangement. First item to recognize is that all of your closing costs will need to be paid out of that down payment. So while you may be receiving 20, 25% down from the buyer, that's also going to be reduced by title, escrow, brokerage commissions, excise tax, if that's applicable based off where the property is physically located. And then beyond that, if there is already a loan on the property, then that mortgage is going to need to be paid off at the date of sale as well. So that will further deplete the available funds. The remaining amount is all that is 1031 exchange eligible. If you elect not to exchange, then you would recognize tax on those funds. What you unfortunately cannot exchange is the portion of the note, the note balance, if you will, that would then be paid off 5 years down the road. You will have temporary tax deferral until that balloon payment is made. Or if you receive installment payments where each year on the 1 year anniversary, you are receiving, let's say, a portion of interest income and a portion of principal pay down, then you would recognize a pro rata share of tax due on the sale in each of those payments. But you have temporary tax deferral until that note is ultimately paid off if it's a balloon payment. And another item that's worth noting that's often overlooked is the fact that when that balloon payment tax is due, it's due at the tax rates that are applicable at that time. So when using this structure, you're also absorbing a certain amount of tax risk should long-term capital gain tax rates, should net investment income tax, depreciation recapture tax, or state income tax rates move up in that 5-year period, it would be that tax rate at that time that would be applied to those funds. Last item to note is if an owner were to pass away during the note period, unfortunately, you do not receive a step up in basis for a surviving spouse or ultimately for beneficiaries. So you lose that advantage if someone were to pass during the period of the note term itself. Ultimately, what we'll often counsel clients of ours is to say, look, it doesn't mean seller financing isn't the right option for you. However, there needs to be a healthy premium in terms of the value, the price at which they're transacting on the property in order to outweigh some of the downsides, if you will, from a tax component standpoint. So first poll question we have here, Alexander, if you'd mind launching that, is how familiar are you as investment property owners or advisors, people affiliated with investment real estate, with 1031 exchanges? So I'll give you a quick moment to answer that question before we move on to the next slide here. Perfect. Thank you, everyone who responded. It's a good segue into just what are 1031 exchanges. And it sounds like the vast majority of you are at least somewhat familiar with exchanges, which is great. 1031, Section 1031 of the tax code is referred by many as one of, if not the most advantageous section of the tax code. And that's with good reason, because what it allows for is an individual or entity that is selling investment real estate, provided they follow the necessary steps to take the sales proceeds resulting from that property sale and acquire replacement property, all the while deferring all of those earlier taxes that we were discussing: federal capital gain tax, depreciation recapture tax, net investment income tax, state income tax, not paying those taxes, but instead deferring that tax liability into replacement property. Now, I'm using the term property both in the singular and the plural. That could mean selling a single property and acquiring a single replacement property. That could mean selling a single property and acquiring multiple replacement properties. Or the inverse, selling multiple replacement properties and acquiring a single larger property. All of that is allowable and available within a 1031 exchange itself. There's a term that you'll commonly hear utilized within the context of 1031 exchanges, and that is like kind. Now, at first glance, it's very easy to misinterpret like kind to mean if you are selling a particular property type, say a single family rental or an apartment building, that the property that you acquire, because the IRS stipulates it must be like kind with one another, has to be that same property type. And while that's understandable that people would assume that, in practice and in reality, the IRS is not actually concerned about the property type itself, but instead the intent as to why that property is owned. And for all intents and purposes, most people only really need to be aware of two categories here. There's personal use property. This would include your primary residence, a family vacation home, anything that is used exclusively for personal purposes. And then there is property that's held for business or investment purposes. Importantly, all property, regardless of property type, provided it is located in the United States, held for business or investment purposes, is considered like kind with one another. So now we open up a myriad of strategies. You can sell a single family rental and exchange into owning agricultural land or a retail property, commercial office, self-storage, hospitality, industrial, you name it, does not matter what property type, provided it is held for business or investment purposes. Additionally, that means that you can sell a property in, let's say, California and exchange into a different market. You can exchange anywhere in the United States. Now, unfortunately, you cannot exchange into international property or vice versa from international property into domestic property. But there's quite a bit of flexibility provided the rules and requirements that the IRS put forward are met. What are those rules and requirements? Well, first, before you actually close on the sale of your property, if you plan to perform a 1031 exchange, you must open up an exchange with what's called a qualified intermediary. You'll also hear the term exchange facilitator or exchange accommodator used. This is an entity that will hold on to the sales proceeds on your behalf while the exchange is being performed so that you do not take what the IRS calls constructive receipt of the funds. And that's just a fancy way of saying possession of the funds. So upon the sale of a property, before the sale closes, you set the exchange up with the qualified intermediary. They communicate with your escrow office. And then when the sale closes, funds go from the buyer to escrow. They would normally go from escrow to you as a seller, but given an exchange is being performed, they go from escrow to the qualified intermediary who holds on to those funds for you. Now you are in your IRS mandated exchange timeline. And from the date of your sale onward, we'll call the date of the sale day 0, you now have 45 days to identify your replacement property, at which time, if your exchange continues to go on, you have to submit a formal identification listing the properties that you are either considering or plan to purchase. And after that 45th day, you cannot make any modifications to that identification form. Now, you can over-identify. You can identify more property than you actually plan to purchase, but there are also limitations on that front, which I'm going to circle back on in a second here. Moving forward with the timeline, though, you now have an additional 135 days to actually acquire your replacement property before the exchange closes. If you do not purchase adequate replacement property within that 180-day total timeline, so 6 months post-sale, then any funds that you did not exchange or any replacement property that you did not replace would be taxable to you. It's called boot in 1031 exchange language. Let's circle back on the 1031 exchange rules that are in place. You cannot, unfortunately, identify an unlimited amount of replacement property. There are 3 different approaches that can be taken for identification purposes, and you have to select one of them. You can either identify up to 3 properties, regardless of the value of the property you're identifying. This is called the 3 property approach. Second, you could identify up to 2 times your sales price of the property, regardless of the number of properties that are included within that. This is what's referred to as the 200% approach. Or third, you can identify any number of properties for any aggregate value, provided you ultimately close on 95% of the value which you identified. Some people will refer to this as the all or nothing approach because you're effectively planning on purchasing and must purchase everything that is identified. One of those 3 methods needs to be selected for putting forward the identification to the qualified intermediary. But within those rules themselves, there is lots of flexibility associated with 1031 exchanges, such that your replacement property can serve to address your specific objectives. So with that background on 1031 exchanges, second poll question here, which exit strategy do you as a property owner, whether you're planning on selling in the near term or down the road, plan to utilize? Alexander, if you could go ahead and launch that second poll question. Perfect.
I don't think you can see what's going on, but
Oh,
there.
it just popped up for me, so
Oh,
I can
good,
see it
good.
now. Yep, yep,
Yes, the not sure yet is definitely in the lead here. Obviously, that might be why a lot of you on the call today to try to
yep,
figure out which
which
one
is
is the
great.
right one. Yeah, DST is second most popular here. So about half of you have participated. Get in your vote real quick. One last chance, and I will go ahead and share the results in just a moment. Oh, Kathleen says might do the cash and the 1031. Cash out and 1031. All right, let's share these results. There you go.
Excellent. All right. Well, it's good, honestly, to see that half the results are falling in that not sure category, because that is very much consistent with the approach that our firm takes of you need to know what your options are. You need to understand those options. And ideally, you're starting that educational journey before there's a timeline that you have to adhere to. Before the train's left the station, with the property having been listed or under contract to sell, or a close date that's fast approaching, much less finding yourself in your identification period of your 1031 exchange. And Kathleen raised a good point in her response, which is you very much can mix and match these options. These are not all or nothing. You can choose to perform what's called a partial exchange. You can exchange a healthy portion of the proceeds, half the proceeds, whatever it might be, and then pay tax on the remaining amount. Or you can exchange into both DST replacement property and acquire a fee simple property. So they can be combined and customized to address each individual property owner's unique objectives. So last question we have here, or excuse me, last slide on this before we dive into Delaware Statutory Trust, is again just a quick snapshot of ownership structures that are eligible for 1031 exchange purposes. I'll work right to left here. Fee simple is the term used for any property that is owned either outright by an individual or with financing with debt, or by a closely held group of individuals. Could be business partners, could be siblings. The common theme being all of those partners likely know one another, and it's a controlled, closely held group. The other two categories, the Delaware Statutory Trust and the tenant in common, are the two fractional ownership structures that allow you to exchange into owning large institutional quality properties. So here's a scenario where someone might exchange into owning a portion of a 20, 50, $200 million property. They're typically passive as investors. They're going to be receiving commonly income on a monthly basis, depending on the investment strategy associated with that property. That will almost always be the case within the DSTs, commonly the case in tenant in commons. And it begs the question of, well, what are the distinctions between these two fractional ownership structures? The Delaware Statutory Trusts were approved by the IRS as eligible for 1031 exchange purposes back in 2004 through a revenue ruling 2004-86, if anyone's looking to read any tax legislation in their spare time. There are parameters that Delaware Statutory Trusts have to adhere to in order to be eligible for exchange purposes. And those parameters more or less define the sandbox in terms of what quality property, what size property, and the investment strategy available for that property can be construed as a DST. And typically what you're going to see is a focus on newer construction, fully stabilized, higher quality income producing properties. The tenant in common property has a little bit more flexibility that can allow for more active value add strategies, ground up construction, refinancing of the property, with the caveat though that in order to make major operating decisions for these properties, you have to have unanimous consent among the investors to make those decisions, which can be difficult to do when you have multiple unrelated investors who acquire a particular property together. The way in which we utilize these two ownership structures is most people gravitate toward the Delaware Statutory Trust, given the client profile whom we typically serve. However, tenant in commons can be utilized for larger exchanges. Typically, we see a significantly higher investment minimum here. Usually it's $1 million investment minimum, whereas Delaware Statutory Trusts are commonly $100,000 investment minimum. And typically this is going to be a more active value add strategy, perhaps slightly higher risk profile associated with it, or there will be a refinance component that comes down the road. So why consider a 1031 exchange? And before we dive into this, I'm going to ask Alexandra to launch the third and final poll question, which is, what are your motivations for considering selling investment real estate? And based off reading this question here, it says the top goal. What we commonly see in working with investment property owners is they have multiple objectives. It's important to prioritize those because sometimes those objectives can inevitably be at odds with one another. Say, for instance, that common quip we hear of, I want the highest potential return with the least amount of risk. Well, those two don't exactly go hand in hand with one another. But it's important to outline all of your objectives, then rank order those objectives, and then develop a strategy that can work to solve as many of those objectives in order of priority. Some may be non-negotiable as possible.
All right, I'm going to close up the poll here since we have more than half of you in. A couple more responses coming in. Let's see the results. No surprise, reduce management headaches. That's always a priority, I think, for landlords that have had lots on their hands for many years. So, and then it kind of goes down in the order that the
Yep.
responses are listed, which is funny.
And fairly even distribution from the second through the fifth response here. And that's reflective of the conversations we have with investment property owners. I mean, all of these can be addressed through the context of a 1031 exchange. It's just a matter of how that exchange is structured, and then in turn, the replacement properties that are included in what is often a diversified portfolio for clients whom we work with. So why consider an exchange? For many, as noted in the poll that indicated that this is often a common objective, it's about lifestyle preferences. It's that recognition that as you get into these more traditional retirement years, let's say, that time becomes a scarce resource. And whether you want to be spending your time pursuing hobbies with grandchildren, traveling, whatever it might be, often individuals are not wanting to spend the amount of time required to properly manage investment real estate, especially knowing the fact that the problems that tend to surface almost seem to always occur at the worst possible time, when there's a freezing spell and the nights are cold and pipes freeze, or during the holidays, whatever it might be. Typically, that's when you see a lot of the issues surface with investment real estate. So lifestyle preferences, taking a step back from active management, escaping a regulatory environment that has probably changed rapidly over the last 5-6 years. That seems to only move one direction, which is much more in favor of the tenants and increasing tenant rights. It could be recognition that as one has built their investment real estate portfolio, odds are they developed a skill set and expertise in a single property type, and then acquired properties within a fairly confined geographic range, typically a commutable distance from where one lives. And while that is probably one of the best ways to build and grow one's portfolio, it also presents a certain level of concentration risk. If there were a significant regulatory change, or when in that capacity, if there were, heaven forbid, a natural disaster, or if market conditions changed where those properties are located, it could adversely impact a significant portion of an investment property owner's overall net worth because they are concentrated. So diversification from a market standpoint, from a property standpoint, is often a objective that many individuals have. Estate planning. While owning investment real estate, deferring one's taxes through 1031 exchanges, keeping all those dollars working for you is a great way to grow and continue to build on one's overall net worth, it can present some complexity when transitioning down to beneficiaries, especially if you have, let's say, for example, multiple children intended to be one's beneficiaries. Very rarely is there a clean and easy way to divide those assets up among the beneficiaries without forcing a co-ownership, co-management situation. So how does one structure their investment real estate holdings to allow for a seamless transition that can be done without their potentially creating the conflict that may surface should there be co-management among that next generation? And then from a financial standpoint, many of these we've touched on already today, but there are a number of objectives that commonly surface, probably the most common one being someone who has owned investment real estate that has appreciated significantly, but the income as a percentage of equity in that property, not original investment, but the equity that they have today based off of today's valuations has declined over time. And to be clear, that is often not due to mismanagement. It's just a reflection that the growth in the appreciation has outpaced the growth of that cash flow. And are there opportunities then to sell that single family rental condo? Those are probably the two worst offenders from a property type standpoint when we look at return on equity from a 2%, 2.5%, 3% cash flow and reinvest in replacement property that could meaningfully increase the income one earns. So there are a number of objectives that are addressable by way of 1031 exchanges. And let's walk through a quick illustrative example of a couple whom we worked with earlier this year and their objectives, their scenario, and ultimately the replacement property portfolio that they ended up investing in. So here we have a husband and wife who owned, I believe this was a 12-unit apartment building they had purchased in the early 1990s in Los Angeles. Property was acquired for just under $1 million. Importantly, by the time we began working with them, which was late 2024, and then ultimately the transaction occurred in early 2025, they had owned that property for 33 years, which means given the fact it was a multifamily property, which the IRS classifies as residential in nature, with a 27.5-year depreciation life, that property was fully depreciated, meaning every dollar of rental income that they were earning from the property, net of operating expenses, was fully subject not only to federal income tax, but also state income tax. The value of the property was just shy of $3 million, $2.75 million. And at first, when we began communicating with them, they knew that they wanted to sell the property, but they didn't necessarily know what they wanted to do from that point forward. Like many of you who are joining us today that noted not sure when it relates to when asked about the exit strategy in which you plan to employ. We then went through calculating the estimated tax liability upon the sale of the property, and the figure that was landed on was about $865,000 of tax. Now, they had no debt on this property. And when you look at it face value, purchased for $950, sold for $275, yes, recognition that there was closing costs, so now we're down to $2.6 million net. They felt great about those numbers. But when they saw that if they paid the tax liability, they would end up having to then pay an $865,000 tax liability, that changed the tone and tenor of the conversation. And instead, they said to us, what tax deferral strategies do we have available? Ultimately, they elected to exchange those dollars. We designed for them, based off their specific objectives, a diversified portfolio of DST replacement property that then generated 5% first-year cash flow for them, with the expectation that that would grow year over year, and then they could decide what they wanted to do with those proceeds when the DST properties eventually sold. Not only did they have a significant increase in income, I believe they were sitting at around 3.5% or 4% cash flow before the sale of the property, so moving up to 5%. But additionally, because they exchanged into leveraged replacement properties that generated new depreciable basis for them, they simultaneously saw their taxable income go down. So their actual income that they received went up, their taxable income went down by way of new depreciation. Very meaningful for California residents because of that high state income tax. And this slide demonstrates a very simplified comparison side by side at just a 5% first year yield, what it would look like had they not performed an exchange. So what you see here is two columns, same net sales proceeds, same gain, same accumulated depreciation, and then what the estimated tax liability would be. And then in turn, what that translates to from funds able to be reinvested. And at 5% cash flow in both scenarios, if they reinvested the pre-tax proceeds versus the post-tax proceeds, there's about a 40% difference in terms of first year income. So now with all that information on 1031 exchanges, the case to be made for tax deferral, the flexibility as it relates to addressing objectives, let's pivot into discussing what is often a lesser known replacement property option. What are Delaware Statutory Trusts? As I mentioned before, Delaware Statutory Trusts are an ownership structure that allows for individuals to exchange into owning a fractional interest of large institutional properties. Mechanically, what occurs here is a firm like ours will perform due diligence on what's referred to as a DST sponsor. The sponsor being a large institutional real estate company. Average assets under management of sponsors that we work with sit somewhere between, say, $4 to $5 billion. So these are not small operators. These are large firms. And should we approve of the sponsor, then we will begin looking at and performing due diligence on each and every property that they acquire. I would say on average in today's environment, about 50% of the properties that are put forward by approved sponsors make it through that property level due diligence process. But what occurs with the DST is a DST sponsor will identify a property that meets their investment criteria, goes through their acquisition underwriting and due diligence, and the sponsor will actually acquire the property first using their own balance sheet, their own capital. What that means then is this property, once acquired on day one, wholly owned by the sponsor, is effectively on the shelf available inventory for other individuals that are performing exchanges to then invest into acquiring a portion of it, a fractional interest. And when an investor exchanges into owning a fractional interest of that property, they're displacing the capital the sponsor used to originally acquire it until eventually, over typically an 8 to 10 week period, enough investors will have exchanged into that property that it's wholly owned by those investors. The sponsors received all of their original capital that they used to acquire the property back out of the property, or somewhere around 95%. It's not uncommon for a sponsor to retain, say, a 5% interest in the property. And then that sponsor can use those dollars to go acquire another property. And the sponsor stays on board from a management standpoint to asset manage and sometimes even property manage the underlying property in the DST over the life of the investment. Typically, we see the DST property being held for on average 5 to 7 years, producing cash flow that's distributed to the investors, often on a monthly basis over the life of the investment. And then ultimately they will sell the property to whomever is willing to pay the most for that property, which is typically going to be another institutional buyer, be that a life insurance company, a pension plan, a university endowment, maybe a real estate investment trust. And then upon the eventual sale, all of the sales proceeds, including any appreciation the property realizes, legally has to be distributed back to each of the individual investors, pro rata, consistent with each investor's percentage ownership that they have. And then each investor gets to decide what they want to do with the sales proceeds. For those that realize the step up in basis during the hold period, they're just going to take the sales proceeds because they have little to no tax consequences at that point. For those that have yet to realize a step up in basis, now they get to decide, do I want to pay tax? Do I want to perform a subsequent exchange? If so, do I want to exchange into a new DST property or into a property that I own myself? So lots of flexibility as it relates to the eventual exit. Why would someone consider exchanging into DSTs? Number of reasons: higher cash flow, passive investment, higher quality property, ability to diversify, ease of estate planning to transition to beneficiaries, and a number of other considerations on top of that. Now, one item that's worth noting is that while a DST may own a single property within it or a portfolio of property, almost without exception, each DST will only own one property type. And this is important from a number of standpoints. One, it certainly streamlines and simplifies, if you will, our due diligence process. Because when we are evaluating, let's say, a market that a property is located within, we're going to look at a market from the context or the lens of an industrial property far differently than we would look at the market for a multifamily property. In an industrial property, we care about infrastructure, logistics corridors, proximity to major metropolitan areas, where a property falls relative to that particular tenant's supply chain and manufacturing, distribution, etc. Very little of that do we care about if we're underwriting a multifamily property. Now it's about demographic trends, median income. It's about population growth, the quality of the schools, diversification of employers, tenant amenities in the surrounding area, congestion and commutability. All of those factors are taken into account that are separate from that of looking at a property in that industrial lens. Additionally, different property types have different return profiles, different investment strategies, and it really empowers the exchanger along with the advisor to mix and match different property types together to create a custom curated portfolio for that particular property owner's objectives, which for some people is focusing on a single property type. For others, it's blending multiple property types together. And you have complete flexibility in doing that, given you're not forced into a predetermined mix of different property types that have different attributes associated with them. So why are DSTs popular for 1031 exchanges? Back 10 years ago, when I started working in this space, tax deferral strategies, tax strategy for investment property ownership exits, securitized replacement properties, we saw interest and momentum in this direction. To the tune of about $2.5 to $3 billion of equity being invested in DSTs each year. Ultimately, by 2022, that number grew up to about $9.5 billion. So there was significant growth over the first 8 years or so. Then, as a result of interest rates going up, transaction volume understandably declined in 2023 and 2024. And now it's looking like we'll see about $7.5 billion of equity, making for a total of around $11 to $12 billion of total property value acquired by way of DST ownership in 2025. Why is it becoming a popular replacement property option? Well, first and foremost, many property owners own in markets that have experienced a lot of appreciation, but they do not feel comfortable continuing to own in those markets over the coming 5, 10, 15, 20 years. That could be in a response to legislation, regulation, demographic trends, increases in taxes. This is a very common sentiment we hear from owners on the West Coast, Washington down through California, and in the Northeast. And they're hearing about and they're seeing what's occurring in the Sun Belt, in the Midwest, and saying, I feel like there's better opportunity over the next decade to be invested in those markets. And while it may not be reasonable or conceivable for me to physically relocate, my community lives here, my family, my grandchildren may live here, I'm not going to outright move, but at least I can use DST replacement property to exchange into properties located in those markets and not have to have boots on the ground there and learn that market, oversee vendors, oversee management, etc. So exposure to markets in which you may not feel comfortable owning a property on your own. Additionally, there's no real closing risk associated with investing in DSTs. because of those steps that I outlined, whereby the sponsor acquires the property first, and if there's financing on the property, that loan's secured on the property, the projected financials are built, the insurance policies are put in place, the property condition report and engineering analysis, appraisal, environmental, all of that is done before an investor actually sees the property and is made aware of it as an option to exchange into. From the date in which an exchanger says, yes, that's a property in which I'd like to invest in, if your exchange is open and funded, you can close on that ownership in as little as 3 to 4 days. It's a very quick process. Now, there can be plenty of discussion and analysis and review before making that determination. But once you make that decision, the actual close timeline is very quick, which reduces the risk of ever having a failed 1031 exchange, as well as provides continuity of cash flow. So it's often the case where we'll be working with a property owner designing their portfolio while they're under contract to sell their property, such that on their sale date, let's say they close on a sale on December 1st, that portfolio is already built, designed, and we're just completing paperwork and reinvesting the proceeds, and they could be receiving income as of December 5th moving forward from that point. Estate planning, the ability to divide ownership up further among beneficiaries, and while they're still in a co-ownership arrangement, they're no longer in a co-management situation. That's a common objective as well. But there are a number of reasons why DSTs have become a prevalent replacement property option. This is a quick glimpse here of what we often see be the case where an individual is, say, selling that California single-family rental or multifamily property and then building a portfolio of properties located in other states with a lower tax structure, with a more favorable business climate that provides diversification not only from a property type standpoint, but also from a market standpoint. And here what we have is speaking to the concept of tailoring a portfolio to an individual exchanger's objectives. Now, this is always a customized process. And often I'll talk to property owners about DST replacement property, or any of the other exchange advisors on our team will be having those educational conversations. And an owner will say, well, just send me your top recommendations. And while we absolutely could share illustrated properties for them to review, the approach that our firm takes is truly tailoring the recommendations to the individual owner's objectives. And those are going to be different owner to owner. So this just demonstrates that concept where we have two kind of illustrative portfolios, if you will. The one on the left in the blue is focusing more towards higher cash flow, and importantly, stability of that income stream. There's still diversification throughout the portfolio from a property type standpoint, likely from a geographic standpoint as well. But what you'll see is the portfolio is weighting toward long duration net lease properties, where typically you'll have a full corporate guarantee on that income stream and significant predictability as it relates to that cash flow. And that's not just the cash flow today, but given these are often 10, 15, 20-year leases, even though the property likely will not be held that long, you have a high level of visibility into what the year 1, year 2, year 3, year 4, year 5 cash flow might look like. Great for planning purposes. Alternatively, more of a growth focused portfolio is going to likely weight towards short duration lease properties. This would be inclusive of multifamily, senior housing, student housing, self-storage, hospitality, being the shortest duration lease with nightly rental rates. There can be and likely will be a little bit more fluidity in the income. However, that cash flow should trend upward, and historically, we've seen significantly more appreciation in a portfolio designed this way. Neither of these are recommendations for any one individual. It just gives a glimpse as to how a portfolio can be designed and tailored to address an individual exchanger's objectives. And then our next few slides here, I think really could be viewed as exhibits almost, if you will. This is just a quick glimpse of 3 maps around the United States, showing some of the concepts that we've talked about as to why someone might consider exchanging out of a market in which you own today into markets where you may see opportunity. So first, what we have here is state income tax by state. And I'm going to give a quick caveat here. If I know it's small for everyone to see, but if you look at Washington, there's 3 asterisks next to the state abbreviation. That's due to the fact that while we do have a 7% capital gain tax in Washington, technically as it stands today, real estate is excluded from that. But highest state income tax, California. That's no surprise to anyone, 13.3%. Other high states, New York, Minnesota, Oregon, Hawaii as well. Non-income tax states. Well, you have Texas, Florida, Tennessee, Wyoming, South Dakota, Alaska, Nevada. Of those 9 states, really there's 4 or 5 of them in which you would, or we would consider seriously underwriting a property within and investing in. And then many of the states have low tax rates associated with them. And sometimes they're in places in which you wouldn't necessarily expect. Say for instance, Indiana and Ohio have low state income taxes. I'm kind of tucked up there in the Midwest where they're wrapped around by a number of states that have higher state income taxes. But look at this slide, take a quick mental snapshot of where the taxes are higher and where they're lower around the United States. Next, let's move on to migration. This is looking at net inflow and outflow of people using the best available 2024 data that we have. And I'm emphasizing best available because US Census Bureau data is the gold standard on this front, but as you all know, that's not an every year occurrence. So in between those years, what we're relying on is moving companies. Where are the one-way trips happening to and from? And then increases in payroll is layered on top of that. So those states that are on the burnt orange, borderline brown gradient are going to be the states that have seen the largest outflow in 2024. Those states that are trending turquoise to darker green are going to be the states that have had the largest inflow on a net basis. The states in which people are moving to, Mountain West, Sun Belt, Mid-Atlantic, Carolinas, Florida, Georgia, Alabama, Texas, Arizona, Nevada, Idaho, Colorado, to a certain extent, Tennessee as well. Is there a correlation between state tax rates and migration? Probably. It seems to be so right now and has been over the last 5 years. And then lastly, regulatory environment, often a major consideration for individuals who are contemplating the sale of a property. Now, landlord-tenant laws are more commonly handled at the municipality level, not at the state level. There are exceptions to that. California and Washington are good examples of this, where you see significant regulation at the state level, but for the most part around the country, it's handled at the either city or county level. So we're showing it here based off of municipalities. Those that are red to yellow or orange rather have a more aggressive landlord environment. Those that are shifting yellow to green, you're going to have a more favorable regulatory environment from a property owner standpoint. Again, you layer all 3 of these maps on top of each other, and it definitely suggests Mountain West, Southeast, and parts of the Midwest as well. So in conclusion, as it relates to DSTs, what you see here is a overview of a number of the attributes that make DSTs a popular replacement property option. We've talked about that at length. I'm going to focus on the other side. It's important to note that Delaware Statutory Trust replacement property is not a silver bullet. It's not the perfect replacement property option for every owner profile. There are considerations that need to be taken into account when determining whether it's a suitable replacement property solution for an individual. First and foremost, it is an inherently illiquid investment. I've made reference to that 5 to 7 year hold period. For DSTs to be suitable, one needs to feel comfortable with their investment being in place for 5 to 7 years before they ultimately see the sales proceeds of that property. Second is, we are talking about direct ownership of real estate. Even though you don't own the entire property, you own a fractional interest of one or multiple properties, it still very much is investment real estate. That's why it's eligible as like-kind property for 1031 exchange purposes. And that means inherently there are risks associated with it. The cash flow, the appreciation, those are not guaranteed, the income may be contractually guaranteed by the lessor, the tenant in a particular property, if you're talking about a Kroger grocery or a Tractor Supply or an Amazon fulfillment center. And we may feel very, very confident in that tenant's ability to pay. However, technically, from a return standpoint, the returns themselves are not guaranteed. There are structuring costs associated with DSTs that are worth being aware of and learning about. And then, of course, in utilizing 1031 exchanges in investment in real estate in general, there can be potential changes to tax law down the road, none of which is imminent at this point, that would end up having an implication for the strategy of continuing to defer your tax liability until a step up in basis is realized. And then lastly, just so we're on record saying it for a second time, you must be an accredited investor, typically net worth over $1 million, in order to exchange into Delaware Statutory Trust replacement property. Now, if you're interested in learning more about DST properties, seeing illustrated properties, or having a portfolio designed for you, regardless of whether you're considering a sale in the near term or in the distant future, what I would encourage is for you to reach out to our team, have a conversation with one of our exchange advisors. They can share information with you, address your questions, learn about your objectives, and then design a portfolio for you or share specific properties with you. Additionally, you can visit our website, in which we have our DST marketplace available, where anyone in the general public can see closed properties for illustrative purposes, or if you request access and we have a quick conversation to confirm accreditation, you can also see currently available properties. Our guide to investing in DSTs is a great resource as a starting point to learn more about the history and the structure and the mechanics and strategies available using Delaware Statutory Trusts. Also available on our AAOA hub page. That's a free download PDF guide that you can go ahead and access if you are interested in diving deeper. That website for the marketplace can also be found on our AAOA hub page. So again, anyone can see closed properties that are no longer available for exchangers. And then if you'd like to see currently available properties, you can request access to do so. If you're interested in having a conversation with one of the exchange advisors on our team, you can do so by calling the number at the bottom of the slide. We're always happy to have a conversation with you. It's complimentary. There's no charge associated with it. Or you can actually visit that hub page and schedule directly on the calendar of one of our exchange advisors as well. And then lastly, webinars are a near weekly occurrence here at RETS. We also record all of our webinars and have an on-demand library available for any topics that resonate with you so that you can watch them at your leisure at a time that's convenient for you. Some of these topics are early stage, more foundational knowledge. Others are very specific and dive deep into concepts such as estate planning. And sometimes we'll introduce some cash investment opportunities as well, such as a presentation we have coming up in mid-December for a value add real estate fund, Hamilton Point Real Estate Fund 15. Well, Alexandra, that's all we have on our end. Happy to talk through any additional questions that might have come through throughout the course of the presentation.
Yeah, thank you so much. You spoke very clearly, and I think really broke down a lot of questions people probably had. So one here that I had that you didn't cover is from Stella. With a 1031 exchange, can the FERPA fee be waived for a foreign national seller?
Yes, it can. And that needs to be disclosed to escrow that you're planning on performing an exchange. But that the tax that's due upon foreign national sellers is only applicable if the tax liability is actually recognized. So just like any of the other federal taxes or state income taxes applicable, or some states will do withholdings at escrow too to kind of prepay your tax liability. You have to communicate to escrow you're planning on performing an exchange, and then they won't deduct that from the sales proceeds.
Great. Also, I want to mention that I did include the consultation link in the chat, as well as the AAOA hub, which has all of the free resources. And I will be emailing you those links tomorrow in case you don't catch them right now with the recording. So you can, hopefully not miss out on those great resources you guys have to offer. Eric has a question. How does Delaware Statutory Trust compare to Wyoming?
Good question. So my understanding is that there are a number of states, Wyoming being one, Alaska being another, that have similar trust structures that can allow for the fractional ownership and eligibility for 1031 exchange purposes. But Delaware was the first state to embark down that path. And then thus, is the primary trust structure. It's using Delaware trust laws. Many people who I've encountered that use Wyoming trust are doing it for privacy purposes because there is no need to disclose who the trustees are within it. And so we haven't seen it used in fractional ownership. It may be possible, but the Delaware Statutory Trusts are specifically what are called out in that revenue ruling 2004-86 that I made reference to, and so is thus used for this particular transaction structure.
Okay, thanks for clarifying. Henry asked, what is the average management fee for net lease property in a DST?
Typically for asset management, we're going to see somewhere between 1 and 1.5% of effective gross income.
Okay. Tripty says, I heard you need to buy a 1031 exchange property that is at least the sale price of the investment property sold. Can you confirm?
Yes. So from a value standpoint and a reinvestment standpoint, if the goal is to have full tax deferral, then there's two requirements that need to be met. First is the sum total, the aggregate value of replacement property needs to be equal or greater value to that which was sold. However, that's not based off the gross sales price of the relinquished property, the property that's sold. It's based off the gross sales price less the closing costs. So title, escrow, excise tax, brokerage, not the loan payoff, just the closing costs. So you'll hear that term commonly used is net sales proceeds there. So if you sell a property for, let's say, $2 million and you have $150,000 of closing costs, your threshold of total property value that you need to acquire is that 2 million less the 150, so $1.85 million. The second requirement is if you have a loan on your property, or if you don't, but the equity resulting from the sale. So now the loan gets paid off at closing. Let's say in that illustrative example, someone had a $850,000 loan on their property. They will have $1 million in their exchange because the loan has to be paid off at closing to escrow. All of the equity has to be reinvested. So for that individual who sells a property for $2 million, has $150,000 closing costs, has an $850,000 mortgage balance, they need to reinvest all $1 million of replacement property and acquire $1.85 million of property value. How does one go about doing that? Well, you have two options. One is you can make sure that you reinvest all $1 million and have at least $850,000 of debt on top of that on your replacement property. So you're effectively replacing your debt with a new mortgage. Most of the DST properties will have somewhere between 45 to 55% loan to value, which allows you to use the DST properties for debt replacement purposes. Or you can come to the table with outside cash to offset the loan, which most people understandably do not want to do that. And they would have paid off their loan beforehand if they had the cash on hand or wanted to use the cash for that purpose anyway. But those are your two options that you have. So equal or greater property value based off the net sales proceeds, and then reinvest all the equity resulting from the sale.
Nice. Okay. That breaks it down nicely. Ray says, when determining the $1 million minimum net worth requirement, I understand my primary residence isn't considered when calculating. If so, what assets are used to determine if I meet the minimum requirement?
Great question. Simple answer, everything but the primary residence. So retirement accounts, if there's a cash value of a pension, cash, savings, other assets, investment real estate, collectibles, you name it, everything else can be included except for the primary residence. If you own a second home in its personal use, say you have a vacation home, that would be included, just not the primary residence.
All right, great. Sophia says, why does a sponsor want to pay the difference between the sale price of the house and what is left after escrow after the sale? Because it has to be like for like exchange.
Well, remember the like kind requirement means that the property that's being sold has to be held for business or investment purposes, and the property that's acquired has to be held for business or investment purposes. When you sell investment real estate, there are always going to be some closing costs. That technically doesn't have a bearing on the 1031 exchange in any way, other than establishing the amount of replacement property value that's needed to be acquired in order to have full tax deferral. So you get to deduct those expenses, but those expenses on selling the property are being paid to the brokers who represented the buyer and the seller on that property, the county, escrow, title, etc., for all those recording fees and transaction costs. The sponsor does not cover those.
Got it. We had a series of questions from Gina. I would say if Gina's listening, you should probably do a consult to get all of them answered. But I'm going to pick one here that I think other people might have as well, which is the home I'm considering selling used to be my primary residence, but for the past year has been an investment property, tenant occupied. If I do a 1031 exchange on that, do I have to buy another investment property or can it be a primary residence?
It could be either. So not only that, so what is the question's getting at is this concept of if a property has only been an investment property for say a year, and that's important because we have a 3-year window. If it was previously a primary residence, you can utilize what's called a 121 exclusion. And this is part of the federal tax code. The 121 exclusion is for scenarios where an individual has lived in a home as a primary residence for at least 2 out of the last 5 years before selling the property. And in turn, what they can do is have up to $250,000 as an individual, up to $500,000 as a married couple of gain be tax-free. And so if someone, let's say, owned a home for 10 years, lived in it as a primary for 8 of those years, or in perhaps Gina's case, 9 of those years, and then it was an investment property for the most recent year, you're in this scenario where you could sell the property and utilize exclusively the 121 exclusion. And if your gain is, certainly if it's under 500,000, then that would make sense to do. Just take all the sales proceeds tax-free. If your gain is well in excess of that, maybe it makes sense to utilize both the 121 exclusion as well as exchange the remaining funds. And you can do that because at the date of sale, it was classified as an investment property. It had been rented for a year. So that's a scenario where we want to look at it from every which way, every possibility. We have to know the specifics of the sale. Is there a loan balance? How much appreciation is within the property? And then can help to guide which direction to go with that.
Hey, fantastic. And Gina had also mentioned that weather is another reason you can add to your list that people might want to move from California because of the fires. But I know weather issues have been, on the rise really everywhere. That's why insurance is also on the rise everywhere. We'll probably have a webinar about that at some point soon. Well, I'll leave that there with where isn't buying in Florida risky? Yes. It's risky everywhere at this point. But hopefully we can help manage that risk with some diversification, right? That's the point of this as well. So thank you, Austin, for providing all that information. And of course, everyone will get the recording tomorrow along with the AAOA Hub free resources, the book a consultation link. So if you want to talk to Austin or someone on his team about this and really come up with a customized plan, that would be the next best step. Even if you're not planning to do it right now, sometime within the next 12 months, if that's your plan, it's a good idea to start looking at it now before, you get into it too late. And then, maybe some of your options might be limited. So planning ahead is always good. Austin, thank you so much for joining and for speaking to our group today.
My pleasure. Thank you for the opportunity. Hope everyone has a wonderful day.
All right, everyone. Take care. We'll see you next time.
Bye-bye.
Bye.